Hey guys, Professor Dalton here after a little bit of a break. It tends to happen during the fall semesters. It's either holidays or hurricanes or both. And so I had to take some time off for a holiday, and then I had to take some time off for a hurricane. But I'm back, continuing on with our Managerial series. We're going to do Managerial 3 today. And what we're talking about today is going to be really quick, a really simple kind of idea. And that is the fact that basically we're just playing with a bunch of assets. When we are shifting let's just say our products, when we're shifting our inventory, when we're shifting our raw materials to be worked on, when we're shifting those things to be worked on when they're completed into finished goods. I'm, kind of going on the slide here if you haven't noticed, but when we move these items, when we move these things into these different facets of production, we're moving assets around. These are all assets. Well, raw materials, work in process, and finished goods. Those are all asset accounts. They're assets. They are what we use, right, to continue our business, to do our business. Raw materials are our raw materials that say we order. Let's say we're building a house, okay? And we call up our lumber manufacturer and we say we need a bunch of lumber delivered to the job site. So this guy comes, he jumps a bunch of lumber down, and we have raw materials. We're going to build a house out of all this wood. But right now it's just sitting at the job site. It's raw materials. And obviously it could just as easily go to a warehouse if we were in a manufacturing type of a production. But, again, let's keep it simple, kind of that job order costing idea. We've got raw materials, bunch of lumber, just kind of sitting in a vacant lot. They'll be used to make the final product, but we haven't started on them yet. But they're still assets. They're still a type of inventory. That is, they are raw materials. Now, when we start building that house, we're going to move those raw materials into work in process. We're going to take those raw materials and we're going to start adding things to them. We're going to add direct materials, other direct materials, right? If we're building a house, we're going to add some nails. We're going to add some direct labor. We're going to add the person to hammer those nails. And we're going to combine the person and the nails and the labor of that person hammering those nails into this wood to eventually make a finished good, a finished house. But in the meantime, right, we've got raw materials that are sitting waiting to be started on. When we start hammering the nails into the lumber, we've got work in process. We're working on a house. And again, that is an asset because we're combining the values of, basically other assets. Finished goods is another asset. That is our inventory. That's what we're going to sell. When we're done with this house, it is no longer in process. It's finished. But again, all three of those are assets. They're all types of assets. Cost of goods manufactured is basically the cost of this finished house. And we'll see this kind of different from cost of goods sold. We'll talk a whole lot more about cost of goods sold, especially in the financial section. But cost of goods manufactured is more of a, hey, how much did we spend on manufacturing for this house or for this month, right? If we're in a manufacturing process type of a system. But again, this is useful for both job order and process costing, which we're going to get into in a minute, process-based costing, where we're just, again, moving raw materials from the storage, from the warehouse, into in process, work in process, and then it flows there into finished goods. And again, the total amount, let's say, of manufacturing costs for the month would be our cost of goods manufactured. So kind of the flow of costs, right? The way this works, and I've really kind of already said it, we've got direct materials, right, that we purchase in the form of raw materials. When we purchase those materials, we're exchanging an asset for an asset. That is, again, a balance sheet account. When we purchase material, we incur the cost of purchasing the material, but again, we're trading an asset for an asset. All of that exchange, if you will, goes into raw materials, which, again, like it says, is a balance sheet account. It's an inventory account. It's an asset account. Again, we move our goods from raw materials to work in process, and that's where we apply things like direct labor, the guy to hammer the nail into the wood, and the overhead. I would say that would probably be the nails, right? I can't directly trace how many nails are in every house. It would probably be very cost ineffective to do so. So I'm going to call nails manufacturing overhead. I'm going to basically assume how many nails my worker can nail into a house in, say, an hour, right? Remember that? And allocate that cost based on the number of direct labor hours worked. But again, all of these things go into in process because that is, well, what our house is in process of doing, right? It's in process of becoming a house. So I take this raw lumber, I apply nails and labor to it, and it becomes a house. It becomes a finished good. Once I sell that house, it becomes an income statement expense, if you will. So again, remember my rules of debit and credit, normal account balances, and how assets equals liabilities plus equities. What I've done so far when I purchase raw materials, when I pay my labor, when I incur overhead to apply to this lumber to build a house, it's just all exchanging assets for assets. It's only when I sell the house that I recognize the revenue, of course, I mean, we know that, right? But I preface that to say, when I sell the house, I recognize the revenue. Matching principle, I recognize the expense. Up until the point when I sell the house, I've exchanged asset for asset. The asset of the raw materials, the asset of the laborers, all of these costs are actually assets. I recognize the expense of selling those assets when I sell the asset. And again, I recognize that on the income statement. Keep in mind, we do have period costs still. Those are my selling and administrative costs. My period costs are the costs that are not directly related to creating a product. That is to say, they're not inventoriable, right? A product, when I combine raw materials, when I combine the labor and the overhead, these costs are all capitalized, if you will, into the value of that good that I've created. I don't recognize the expense of spending that money until I sell the good. Again, that allows for my matching principle to happen. But recognize my selling and admin people. Think about the owner of the business, let's say. He has nothing to do with the day-to-day creation of that, well, let's say this house, this product. So his salary has no value. It doesn't add any value to this house. I can't capitalize the cost of his salary into my inventory. I have to expense it as it's incurred, and it's called a period cost. This is kind of opposite to product cost. What we see at the top here are all product costs, costs that go into the product. Product costs are inventoried, and they remain an asset until they're sold. Period costs are expensed during the month they're incurred because they do not build into an asset. So again, the way that we kind of flow these assets, when we purchase materials, we're purchasing raw materials. Raw materials, again, that is an asset. It increases with this debit entry into material purchases, raw materials, whatever the company calls it. When we ask for those raw materials to be, well, when we ask for this house to be built, let's say, we are going to call for these raw materials to be delivered to the job site and be worked on, start getting nails hammered into them and take on the shape of a house. This again, for our job cost sheet, this is where we accumulate the costs of all of these raw materials that we're going to put together and combine. And remember also what goes on that job cost sheet, my direct labor. That goes on there too, right? Remember that? So any costs, they're going to go into this job, this house. Let's keep with that example. They are going to be debited into this house's work in process account. We're going to keep its own little account, and we're going to constantly be debiting things to this work in process as we're adding value to this house. Remember a minute ago, we added our raw materials, right, to this job. We delivered our lumber to this job site. And, you know, we probably had some indirect materials as well, like, again, our nails that we would have delivered to the job site. But, you know, we probably just delivered a huge box of nails. So we're going to charge that to indirect materials into manufacturing overhead. So anything that we're calling out of raw materials that is an overhead gets debited to manufacturing overhead as an actual cost. Now notice manufacturing overhead is kind of a weird little account. We've got actual on the left side, on the debit side, and applied on the right side, on the credit side. When we estimate the amount of overhead that this job is going to take, we're going to apply it. Remember, we're going to apply overhead at the estimated rate. But again, spoiler alert, right? Our actual costs they're never going to equal our applied costs. So what we're going to see in the next video is how to settle that difference. But let's move on. Again, we've looked at raw materials, we've talked about salaries and wages payable, how again our direct labor goes straight onto that job cost sheet, straight into work in process. Anything indirect would go to manufacturing overhead. Let's say at the end of a day or a week, someone comes by and just kind of sweeps up all of the job sites in our neighborhood. I can't really tell you how long he spent on each one, but I know his salary needs to get divvied up, if you will, between all of the job sites in the area. So again, the cost of his labor is going to go into the actual manufacturing overhead side. Any other overheads, of course, we will apply to manufacturing overhead, but again, when we apply overhead to this job, to work in process, remember we're applying overhead based on direct labor hours. When we apply our charge, if you will, for overhead, we're not basing it on anything but an estimate. Our actual is not going to equal our applied. It never will. These two will never balance. But again, the reason we want this here is to have accurate-ish, but most importantly, timely information as to how much this house costs. I want to know how much this house costs because what if I get a buyer tomorrow? I need to have an idea, right, of how much this house costs me to build. And I've got it right here. It's, accurate enough, but it will need to be fixed because my actual, again, will never equal the amount of overhead applied. But again, once this house is done, all of my costs sum up to a cost of goods manufactured. The total of my costs to manufacture this house are going to be transferred into finished goods. And remember, these are all asset accounts. So when I have raw materials, I've got a debit balance in raw materials. I credit it to pull them out. I debit work in process. When work in process, when my work is complete, I've got a bunch of debits in work in process. I'm going to credit it really just once to get rid of all these things on the left-hand side. I'm going to put one entry on the right-hand side to get rid of all that. And then I'm going to put a debit entry into finished goods to show the amount of work, the amount of value that went into this house, and it's going to sit there in finished goods until it's sold, right? Once it's sold, I'm going to credit finished goods for the cost of goods sold, which equals the cost of goods manufactured for that one item. Again, keep in mind, my finished goods account, it's going to capture everything I've ever finished. Let's say I sell this house that I just built. I've got 4 houses still sitting in finished goods. The value of the house that I just built gets credited as cost of goods sold to finished goods. We credit the cost of the house that I just sold because that value doesn't exist in finished goods anymore. The value of that house is being removed from finished goods and it's going into the cost of goods sold. Cost of goods sold is going to be your #1 expense account for any manufacturing company, probably most any company, period, because what you're selling is it's likely going to be your most valuable asset. All right, so next time we'll look at how to fix that misapplied overhead. And again, it's always going to be off. It's never going to be exactly right, especially in an accounting class. It's made to not be right. But we'll hit that next time. So until then, I'll see you guys. I appreciate it. Hit the like and subscribe if you would. It helps me out a lot, and it'll keep these videos coming at a more regular pace, I promise. Take care. See you guys.